Welcome to Maximize Your Wealth, the Young High Earner's Guide to Smart Investing. In this video, we'll shift your mindset from saving to strategic investing and tax optimization. We'll cover why timing the market fails, how to right-size your cash, the exact tax-sheltered account order, the backdoor Roth IRA, and how to automate everything. Along the way, we'll include quick quizzes to help you lock in the ideas. Let's begin by mapping out today's agenda, and then we'll ground everything with a quick disclaimer. Here's the roadmap for today. First, we'll debunk the market timing myth. Next, we'll compare lump sum investing with dollar cost averaging. Then, we'll size your emergency fund and reallocate excess cash efficiently. After that, we'll walk through the tax-smart account orders. Subsequently, we'll detail the backdoor Roth IRA and how to avoid common pitfalls. Then, we'll turn to automation so your plan runs on autopilot. Finally, we'll reinforce your learning with quizzes before wrapping up with key takeaways. Before we go any further, this is educational information and not financial, tax, or legal advice. Your situation is unique, especially in high cost of living areas or with employer plan specifics. Please consult a qualified professional and verify current IRS rules and contribution limits as they change frequently. With that in mind, let's anchor the right mindset for your 20s. In your 20s, time is your superpower. Compound growth over decades dwarfs the gains of perfect optimization or market timing. Therefore, your job is to get money invested in compounding as soon as reasonable, then refine. We'll begin with the most common trap, trying to time the market. Let's tackle the biggest misconception, market timing. Studies consistently show that time in the market beats attempts to predict dips. Historically, lump sum investing has outperformed dollar cost averaging most of the time because markets trend upward over long horizons and idle cash suffers opportunity cost. Nevertheless, behavior matters. If volatility makes you freeze, dollar cost averaging can be a useful psychological tool to get you invested. However, keep the schedule short. Think a few weeks to a couple of months, so most of your cash goes to work promptly. A practical approach is to either invest the lump sum now or split it into 4 to 8 equal tranches auto-invested weekly or bi-weekly. In short, the goal is to minimize time spent in cash and maximize time compounding. This flowchart organizes a practical investing order. First, check for high-interest debt. Paying off double-digit or high single-digit APR debt is a guaranteed return and often beats investing. Next, capture your full 401k match because it is effectively free money. Then, build a 3 to 6 month emergency fund to create resilience. If you're HSA eligible, prioritize maxing the HSA because it has triple tax advantages. After that, contribute to a Roth IRA. If your income is too high, use the backdoor Roth to access tax-free growth. Subsequently, max out your 401k to the annual limit. Only then should you direct significant funds into a taxable brokerage, focusing on diversified, low-cost index funds. If your plan supports a mega backdoor 401k, you can add even more tax-advantage savings. Throughout, automate contributions and schedule an annual rebalance. Security matters, but too much cash slows your wealth. A robust emergency fund is typically 3 to 6 months of essential expenses, especially in a high cost of living area. For example, if your bare-bones monthly spending is about $5,000, a reasonable buffer ranges from $15,000 to $30,000. Any cash significantly beyond that, when you do not have near-term large purchases like a home down payment, likely loses ground to inflation. Therefore, reallocate surplus cash into a diversified portfolio of low-cost index funds within tax-advantaged accounts first. Meanwhile, keep any short-term goal money safe in cash or short-duration instruments. To prevent commingling, consider using separate accounts or digital labels for your emergency fund and your investment funds. Here's how the backdoor Roth IRA works. First, open both a traditional IRA and a Roth IRA, ideally at the same brokerage. Next, contribute after-tax dollars to the traditional IRA as a non-deductible contribution. Then, keep the funds in cash to minimize any gains and wait for settlement, typically 1 to 2 business days. After settlement, convert the entire traditional IRA balance to the Roth IRA. You will receive a Form 1099-R from the custodian, and you must file IRS Form 8606 to document your non-deductible basis. Crucially, The pro rata rule applies across all of your IRAs, so maintain a zero balance in pre-tax IRAs by rolling them into an employer 401k when possible. Afterward, repeat the process annually so you can continue to capture Roth tax-free growth even as your income exceeds direct contribution limits. Always confirm current IRS rules and consider professional tax advice. Contribution limits change regularly. The table lists 2024 example limits to illustrate the order of magnitude, but you must verify the current year amounts on irs.gov or your benefits guide. 401k limits apply to your employee deferral. Employer contributions are an addition and subject to a separate overall cap. IRA contributions are subject to income-based rules that affect deductibility and direct Roth eligibility. HSAs require enrollment in a qualifying high-deductible health plan and offer triple tax advantages. Always confirm the latest numbers before setting your automation. When deciding between lump sum investing and dollar cost averaging, remember that lump sum tends to outperform historically because markets rise over time. If you can tolerate volatility, invest the entire amount now. If your nerves make you hesitate, use a short DCA schedule to overcome behavioral hurdles. 4 to 8 tranches over several weeks strikes a good balance. A pragmatic compromise is to invest a large majority immediately, perhaps 60 to 80%, and DCA the remainder over a month or two. Regardless, automate transfers and purchases to remove emotion, and remain invested through news cycles. Rebalance periodically to manage risk rather than attempting to time exits. Let's compare a 3-month versus a 6-month emergency fund. A 3-month buffer accelerates your investing timeline and works best when you have a stable, in-demand job, low fixed costs, and strong spending discipline. A 6-month buffer offers more resilience, which is valuable if your income is variable, you support dependents, or your industry is cyclical. The trade-off is that more cash on the sidelines slightly slows compounding. You can also adopt a middle ground of 4 to 5 months if that aligns with your risk tolerance. Quiz time. After you secure your full 401k employer match, what generally comes next in a tax-smart order for high earners? Is it A, max out a Roth IRA or use the backdoor Roth if ineligible? B, hold more than 12 months of cash in a high-yield savings account before investing? C, allocate most savings to speculative crypto? Or D, aggressively pay off 2% student loans before investing? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A. After capturing your employer match, the next priority is typically to fund a Roth IRA. If your income exceeds the threshold for direct contributions, the backdoor Roth method preserves access to Roth tax-free growth. Excessive cash reserves or speculative assets generally do not outrank the tax advantages of Roth accounts. Low-interest debt like 2% student loans often does not take priority over investing within tax shelters. Second quiz. For a young professional in a high cost of living area without near-term large purchases, which cash level is typically excessive? A, 1 to 2 months of expenses. B, 3 to 6 months of expenses. C, $50,000 or more sitting in a high-yield savings account with no near-term needs. Or D, zero emergency fund. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. While the exact amount depends on your expenses, once you have a 3 to 6 month emergency fund, significant extra cash in a savings account typically erodes to inflation and misses compounding. Redeploy that surplus into diversified investments within tax-advantaged accounts when possible. This mind map shows how each component fuels your wealth engine. Income improvements via raises and side work increase savings capacity. Expense control directs more cash to investments. Your safety buffer, the emergency fund, protects your plan from shocks. Tax shelters, such as the 401k, HSA, and Roth IRA, accelerate growth by minimizing taxes. The portfolio should emphasize low-cost index funds across U.S., international, and bonds in proportions aligned to your risk tolerance. Automation, through automatic contributions, dividend reinvestment, and scheduled rebalancing, keeps the machine running. Finally, risk management and clear goals tie everything together so your strategy remains durable and purpose-driven. To automate in half an hour, first pick your core index funds, typically a broad U.S. fund, a broad international fund, and optionally a bond fund based on your risk tolerance. Next, Set target allocations and place tax-inefficient assets like bonds, preferentially in tax-advantaged accounts when possible. Then, enable automatic transfers from your checking account to each investment account on payday. Execute a lump sum buy or schedule short DCA buys for behavioral comfort. Turn on dividend reinvestment so distributions automatically compound. Create a calendar reminder for your annual rebalance or set tolerance bands around your allocations. Finally, monitor your accounts with a simple dashboard rather than tinkering constantly. Here are the essentials. First, time in the market beats timing the market, so get invested promptly. Second, keep a 3 to 6 month emergency fund and invest excess cash. Third, follow a tax-smart order. 401k match, Roth or Backdoor Roth, HSA if eligible, max the 401k, then taxable accounts. Use dollar-cost averaging primarily as a short-term behavioral tool if lump sum investing makes you hesitate. Automate contributions, reinvest dividends, and rebalance on a set schedule. Lastly, always verify current IRS rules and your plan specifics. To turn insight into action this week, calculate your essential monthly expenses and set an emergency fund target for 3 to 6 months. Next, verify you are capturing the full employer 401k match via payroll. Then, open or verify your IRA setup and review the backdoor Roth steps if your income is too high for direct contributions. Decide between lump sum investing and a short dollar-cost averaging schedule, and pre-schedule your orders. If you are HSA eligible, contribute and enable automatic transfers. Finally, build a simple portfolio dashboard and add a recurring reminder to rebalance annually. With these steps, you will have a durable, automated system compounding for decades. Thanks for watching. If this video helped you, please like, share, and subscribe. I'd love to hear your questions and your personal investing plan in the comments. What's your emergency fund target, and are you going lump sum or short DCA? Share your thoughts and keep compounding.